welcome. This is the Studio Stack podcast. Each week we go behind the scenes and talk to industry leaders about what it takes to build, join, and invest in startup studios. I am your host, Deanna Lesage, and this podcast is your Startup Studio Masterclass. Today on the show, we have Jordan Schlipf, a serial entrepreneur, early stage investor, and the CEO of Rainmaking Venture Studio. Prior to Rainmaking, Jordan helped build one of the world's most successful startup accelerators, Startupbootcamp, and was partner at Vector, a global Hong Kong-based VC fund. Jordan specializes in entrepreneurial education and served as a teaching fellow at the prestigious University College London. He holds a Master in Engineering and Engineering Science from University of Oxford. If you can't tell, Jordan is incredibly sharp and smart, but he has this magical way of breaking down super complex concepts into easy to understand sentiments. I've been a big fan of Rainmaking Studio for a while because personally, I'm really obsessed with corporate innovation, which is the exact domain that they specialize in and excel at. I learned so much from Jordan in this episode. We get into this distinction between startup studios and venture studios, the evolution of Rainmaking from a co-op of serial founders through the first attempt at a studio and the lessons learned from that onto the model they're pioneering today. Talk about why corporates struggle to innovate and how they should think about leveraging scale strengths, what's involved in corporate venture building, how venture studios de-risk the process of creating new businesses, and so much more. But I've held this up enough. It's a brilliant episode. I can't wait for you to listen. Let's get right into it. Hello. Hi, Jordan. I'm so excited to have you on today. I've been such a big fan of Rainmaking, and getting to know you has been such a pleasure. So welcome to the show. Thank you for coming on.
No, pleasure. Thank you. The honor is mine. It's great to be here.
Awesome. All right. So let's just dive straight in. First question. What is your definition of a startup studio?
Well, I'm going to steal someone else's definition. So Sarah Anderson at the Vault Fund, I think, has come up with probably the most concise and elegant definition, in my view. And she describes a venture studio as an entity that acts as either a founder or a co-founder of a portfolio of new companies. And so for me, the concept of that, like the use of the word founder or co-founder, is a really important distinction because it determines obviously the ownership level, but also the relative control over the development process itself. I know some studios don't necessarily share my view in this latter piece, but to me, I view ideation as being a strategically core capability of any studio, and that should not be outsourced. But that's probably my own preferences coming through there.
I think that's a lot of it. I definitely think there's a distinction between kind of a builder studio and some of the other types of studios. And that's one kind of follow-up question that I had for you was, I know Rainmaking operates more as a venture studio, and there's definitely a distinction to be made there. What would be the kind of difference in your mind between, kind of a startup studio that doesn't have a venture fund or the capital capabilities versus,
Yeah, so I think realistically, a startup studio needs to have both the build capabilities, like the build capabilities and the capital function. So absent of the capital function, I'm like, well, how does that work? That's an accelerator. So from my side, it's very clear. In order to be a venture builder of any sort, you have to have both the build function and the capital function in I say in-house, but like it could be a dual structure, but that's the core element.
Yeah, absolutely. And I know we've talked a little bit, and you kind of have told me that Rainmaking iterated on the model, I think more than most, were your words. And so can you talk about the evolution of the studio and how you and the team landed on building ventures with corporates?
Yeah, so Rainmaking actually originally began as a company builder where it was more of a trusted cooperative of serial entrepreneurs. And what I mean by this is my co-founders and I, and most of my co-founders are a wee bit older than I am, but as they were becoming parents for the first time, they were trying to juggle the sort of responsibilities of parenthood, looking at their partners in the eye and saying, oh, I really want to do another startup that's probably going to fail with, oh, I'm going to become, a dad or a mum. Like, how does that work? So the solution that ultimately they came up with was this scenario where each of us would individually go build our own startups, but our own personal equity was owned by a common holdco. So it meant that we had this common holdco, Rainmaking, that was not publicly facing in the early days, where myself, Carsten, Morten, Casper would go build our own startups. And essentially, if mine failed, Carsten's failed, but Casper succeeded, we then share in Casper as well. So it was sort of, giving ourselves like a portfolio across, really a trusted group of serial entrepreneurs amongst ourselves. And that's how it initially began. And we had, some successes very much doing it that way. And then really what we did as well as across that initial journey is we had a lot of assumptions about, oh my God, it's going to be great because you'll be your startup and my startup, and we can centralize some core functions. They're going to be like synergies, and we're going to unlock some sort of efficiencies.
Yeah, share
And
some resources.
yeah, and we tried it, and the only thing we managed to effectively and efficiently centralize was like back office payroll and financing. Everything else needed to be, dedicated and specifically built to the individual startup and match its own culture, right? But what happened next after that sort of initial cooperative type model is we then tried to sort of systematize the process of building startups in a much more traditional startup studio approach. At the time, there was no corporates involved. It was a mix of our own and some, I say angels, but venture capital money. But ultimately, that sort of go around ended up where the studio sort of started. It closed in on one clear winner. So we ended up spinning out a startup that raised a Series A, and the rest of the scaffolding of the studio sort of fell by the wayside. That experience to us, like, we learned so much in that process. And one of the things that we realized, there's sort of two key learnings, but one of them was absolutely, at the time, we were just undercapitalized to create that portfolio of startups. So, we were funding these things out of our own pockets. And I can safely say that when the burn rate per month is coming out of your own personal bank account for the team, it gets pretty twitchy. And then, we just didn't have deep enough pockets to run the studio, do the initial seed investments, pre-seed investments, to get the venture up to the point that it was able to really raise a Series A in the open market. Well, we managed to do that once. We just really couldn't do that cost effectively across a portfolio. So missing that capital function, we ended up sort of collapsing in one venture. The second thing that we really learned was more the operational learnings. So, our views of sort of what works and what doesn't when running a studio. And if you want to go to that, we can unpick all of those. But really, that was sort of the second evolution. And then the third evolution for us was when we, by accident, and it sort of sounds crazy, but it's true, by accident, we ended up falling into building startups with large corporations. So
what was the first kind of iteration of that? Was it just a corporation came to you and said, we know you guys know how to build startups?
Yeah, so it was a byproduct of two things. So one of the companies we'd founded many years ago in 2010 was a startup accelerator network, right? Very similar to Techstars, called Startupbootcamp. And as the accelerator industry evolved, we started getting corporates attached to it. So in the early days, we were actually one of the first accelerator programs ever to take both an industry view and a multi-corporate view. So industry being like FinTech London, FinTech New York, or shipping and maritime, Singapore or Hamburg, right? So we would base an accelerator program in a key industry, not a theme, in a key location that's relevant to that industry. And then we'd get multiple corporates to sponsor the program. And that initially was driven for very selfish reasons. We wanted a bunch of big corporate logos, because that would attract better startups and we'd get better equity stakes and better startups, right? And that what we didn't really expect was corporates going bananas for accelerator programs. And so this whole corporate innovation world sort of exploded. And then we found ourselves with, about 85 Fortune 500s attached to Startup Bootcamp, at its height. And then those corporates started coming to us asking for like, look, this accelerator is fun, but it's not really moving the needle on my innovation needs.
Yeah.
And so we ended up somewhat by accident, again, sort of founding what is now called Rainmaking Innovation, which is just a corporate innovation consultancy. So we ended up building a business, which was sort of basically we're being asked by corporates to do stuff for them. And part of that consultancy business as it grew was we started doing some strategy projects, right? Innovation strategy projects. And so
opportunity type
stuff. Exactly. So we started doing a whole bunch of like opportunity, well, I won't bore you with it, but some strategy stuff for corporates, helping them to navigate how they can see what's coming around the corner and how they deploy a portfolio of different innovation vehicles to kind of better weather the storm, if you will, or better drive strategic growth. And we'd done some strategy work with Jaguar Land Rover, actually back in like 2015. And one of the things we kept sort of impressing at the time, which now is sort of self-evident, but at the time was kind of quite hard for the automotive OEMs, the incumbents, to really understand this, at least emotionally, if not intellectually, was the fact that, making or manufacturing metals with wheels wasn't necessarily the most future-proof business model, given the rise of fleet owners like Uber or Google, or, and EV fleets and stuff like that. And so it could go the same way the airline industry's gone, where Boeing and Airbus make planes for airlines, right? Exactly, and it's a very different model. And so we were sort of pushing Jaguar Land Rover to get into digital mobility and saying, look, you need to be building mobility ventures, which then turned around with, okay, you told us we need to do it, go do it. And I'm like, what?
I mean, I think there's a lot of corporates that want to innovate, and they recognize that their business model isn't going to stand the long, kind of test of time, but they don't have, I'm not sure what would be your answer to that? Kind of, why don't they innovate on their own, even if they have the ideas and the resources to do so? What's the challenge there?
I mean, that's the question, the crux of what's the challenge really with corporate innovation, right? Now, there are some industries that are going to be very different to others. So there are some industry, like for example, the Stone Age didn't end through lack of stone. The same is going to happen with oil and gas, right? They will get to a point where they won't run out of oil and gas, but the actual business model will come to an end. So they will suffer an extinction event, which is very different to other industries, whether it's like, retail pre-e-commerce, post-e-commerce, or, mobile operators sort of, or telephone companies voice and message over IP versus post. So there are fundamental shifts and new business models that are coming in, which is normally the primary driver for disruption or change. Right. But to answer your question, like, why do corporates, despite the fact they have billions in cash and loads of smart people and loads of assets, like, why do they struggle? The short answer to that is the way they make decisions is by looking at a set of data sets, which are like the traditional strategic tools. What are my competitors doing? And they'll look at like normal like signals and the kind of information they're ingesting to make key strategic decisions. By the time that information flow funnels them like a piece of information, which is like, okay, it is now like pretty certain we need to do X, right?
Yeah.
Then the time the market gives them between them understanding we now need to do X, the time it gives them to then be a winner, given their response time as an organization to adapt to that change, is it takes them too long to adapt. So basically the market, based on their normal strategic toolkits, is giving them a time period of, say, I don't know, like, let's call it 10, but it's going to take them 100, of units to actually make that change. So they miss out. So the fundamental reason is they can't turn the oil tanker quick enough because they're not getting the signals early enough. They're not making key decisions early enough.
I agree. And I think, some of my own experience with corporate innovation, I don't know that their incentives are aligned to move fast enough. Like, I think if you have this kind of full-time salary and it's like, yeah, we need to innovate, but it's not really on my shoulders. I don't think they have a startup like chip on your shoulder.
Absolutely. The innovation, so the incentivization is a major issue, right? So if you look at C-suite, the average tenure of a publicly traded CEO is like 4.5 years. And some of the stuff is like, it's not my problem. And ultimately, their huge bonuses are linked predominantly to share price. And so it's kind of like, how do I get short-term share price accretion and leave the problem for someone else to deal with? And so what you tend to see with corporates is like, they tend to go from a lot of cost cutting, a lot of optimization, they're trying to get basic like EPS improvement, like earnings per share improvement. And then the market wakes up and they goes, man, you've completely missed the boat on this stuff. So they bring in a new CEO, and the new CEO is then given this challenge of like, we need to do growth, right? And it's like alternative growth, and we need to turn this ship around. Right. They sort of go in ebbs and flows of that. But ultimately, the incentive mechanisms from the key decision makers aren't really aligned for long-term growth, which is kind of an argument of why private equity does what it does. It's like, let's take it off the public markets. Let's not make it subjective to quarterly earnings or interim earnings. Let's invest in the long term and be a long-term stakeholder more often than not. I mean, some of them flip it in 5 years, but you get the idea. So incentives is a major problem as well.
Yeah, and I think it's interesting that you kind of bring up private equity, and I think there's this really cool sentiment that you have, and what Rainmaking does best is this kind of delivering private equity level risk with VC level returns. And so I think like that is something I would love to kind of dive into. How are you doing that as a company? Like what is this kind of de-risking model that you guys have, you know, put in place and excel at? And I think you have a really robust like process around that and the reasons why, you know, venture studios work in this capacity. So I'd love to just kind of hear a little bit about that.
Yeah, so I'm going to tie that back in because, you know, there's an element here where when we first started building startups in partnership with corporates, and as I kind of alluded to specifically, you know, with Jaguar over the beginning, what we realized across sort of tens of different ventures across multiple different industries is that our initial experience was bittersweet. The sweet side of this was we got really good at leveraging the scale strengths of our corporate partners, which would be like distribution, scaled infrastructure assets like logistics networks, real estate, warehousing. It could be regulation, a whole variety of different, organizational capabilities and infrastructure. And when we did that, we saw our portfolio ventures scale faster than anything we'd ever seen in the wild, but also they would reach scale at a significantly reduced investment cost to get to that point. And so that was like this sort of like, oh, wow, that's amazing. The bitter side to our initial experience when doing this was we then were looking at our initial portfolio of, say, 30-odd ventures with corporates, and we weren't seeing the return on investment or the success rates than we could achieve by building startups in the wild. So we had this like enigma, this conundrum of, hold on, despite all of these scale strengths that our corporate partners are providing us, ultimately we're getting worse results if we just built the startup in the wild without. Like, what? Why? Right. And it took us a while to figure that out. And this is where we sort of came to the realization, probably after more failures than most, that we couldn't consistently, because there were some successes, but we couldn't consistently build successful ventures with corporates within the constraints of professional service firm. So we ended up ripping out all of our corporate venture building activities from our consultancy business. We ended up raising a dedicated fund and launching, Rainmaking Venture Studio as an investment-only corporate venture builder or venture studio. And this whole experience, which we've been on, is coming to the realization that we see corporate innovation, which is a fundamental need that's not going to go away anytime soon, as an investment asset class. And no one else that I've really come across thinks of it that way. And the reason why we get really excited by it is because in our model now, what we've managed to achieve is we build businesses, but because we get to leverage all the scale strengths from our corporate partners, this significantly de-risks the process of building the business while also achieving, scale at farly reduced cost of investment. And so collectively, what we're getting is we're getting better returns on investment than traditional venture capital. So what we've kind of feel that we've cracked here is we found a new asset class, which is sort of more private equity level risk, but with VC level returns.
I love that. I think the way that you're able to de-risk a venture by leveraging the scale strengths of a corporate is the key. That's the kind of winning formula.
Yeah.
And I think that when you're thinking about the corporates that you work with, what scale strengths are you looking for? Like, what's the criteria of how you evaluate the corporates that you work with? What resources should they have and bring to the table, and how does the process work? When they're building with you.
Yeah, so I mean, there's two things. There's like the theoretical scale strengths that exist, right? So when you look at a particular corporate partner, and I'll give you some examples that might have some obvious ones, right? So like we were doing some work with one of the bottling companies of Coca-Cola, and you're like, okay, what are they good at? It's like, well, okay, they have a manufacturing facility that bottles the Coca-Cola. Not so interested in that, but they distribute their product to about 2 million outlets in Europe. 2 million.
Mhm.
So they've got pretty much every single restaurant, they've got every single supermarket, every single cash and carry. They are doing the distribution of their product to. So they've got huge customer relationships to those types of like businesses, whether it's restaurants all the way through to big supermarket chains. Often they're doing their own distributions. They've got huge warehousing, logistics, and like distribution capabilities. And then they've got the products themselves. And you could then say, at a stretch, they've got the Coca-Cola brand.
Yeah, obviously.
And there's like, okay, that's interesting. And then it's like, okay, what business, because what startups and what ventures can we build off leveraging that? But then you might look at another business, which might be, an insurance company. It's like, okay, they've got policyholders, they've got regulation, they've got insurance products, right? And so it's like, you just really, it's always on a case by case basis. But just because they exist, the second question for us is they might exist on paper, but how accessible are they?
Mm.
Right? And some of that is like, how willing is the corporate able to do that? What's the corporate's capabilities of being able to provide that capability to a new a venture? And the second one is like, actually, it might look good on paper, but operationally, do they have space? I'll give you some examples. So like if they say we've got distribution to all these customers, it's like, okay, well, have you got any channels to do that? Like, are they proven? Does it work? Could we access them as a corporate? And they might turn around and say, no way we're giving you access, like risk and compliance, GDPR or something. There's just no way we're going to do that. You're like,
Right.
well, okay, so theoretically you've got great distribution, but practically you're not giving us access. So I'm going to discount that. And then secondly, you might look at someone like, say, DHL, and they're the largest provider of warehousing real estate in the world. They have the largest footprint. Right? At some point, I think Amazon will take them over. But DHL, it's like, okay, you've got this warehousing real estate, amazing. Well, what's the occupancy rate? Because if I am trying to build a business that's leveraging the existing real estate assets, like, do you have any space left in them? Or operationally, like, how easy is it, given what I'm trying to build with the venture, is it for us to access those operations?
Right.
Like, do I have to use your warehouse management systems, or do we, because that might be prohibitive. So there's an element of looking at what are those capabilities and scale strengths and assets. And some of it might just be capabilities. They might be really good at actuarial models as an insurer. It's like, cool, they've got a bunch of actuaries. We can use that to create
Right.
new risk models for a business, right? Whether we're entering parametric insurance or something else. So there's a theoretical capability set, an asset set, scale strengths. Then there's the kind of our due diligence of how accessible is it. And
Yeah.
then, yeah,
Oh,
sorry.
sorry. And yeah, in that diligence process,
Yeah.
in how do you go about as a studio kind of understanding their white space? And I know it's not, there's a lot of corporates will come to you with ideas. They have no shortage of ideas of things that they want to build or what they think that they can do. It's usually some kind of small iteration on their current model, not a completely new
Uh,
business model. And then there's the kind of secondary consideration around, you don't want to build something that cannibalizes their current model. And so you kind of something that's strategically aligned but doesn't disrupt their core business, at least not at this point. So how do you, as a studio, go in and do that
yeah.
ideation work with
Yeah.
them? And kind of how long does it take, and what does the process look like?
So when corporates have ideas, we try our very best to have them not bring us their ideas.
We say no, thank you.
And I don't mean this disparagingly, but it's a stat, so it's a fact. When a corporate has come to us with a very specific idea, i.e., typically it's like, oh, we've got these, like, oh, they've got loads of PowerPoint, they've been working on it for 6 or 8 months. The exec buy-ins, they're very excited by this thing, and they're struggling to go from like PowerPoints to profits. And they basically come to us and like, hey,
Oh, I can't-
could you build this? And when they do that, we have yet to have any of those ideas pass our investment committee. So we've got a 100% kill rate when corporates come to us with fully baked ideas. Our preference is to say, don't come to us with ideas. What we're going to do is we're going to basically understand two things. So one of them is to understand your strategic areas of interest. So looking at your medium to long term, so 4 or 5 years out, what areas are strategically relevant to your business?
Mm,
So kind of like, what's the stuff you're excited by? What's the stuff you cannot do? You'll never be interested in doing. So if I was to pick like a company like Experian, they're a big credit bureau. It's like they've got loads of credit data. Do you want to become a lender? They're like, absolutely not. We'll never allow to become a lender. So, okay, cool. So you know what's sort of strategically out of scope, what's too far away, what might be too close to core, but also thinking a bit more in that adjacency of like 4 to 5 years, like what is the stuff that they're excited about and why? Because the reason why we need to understand that is in 90% of the cases, we're exiting a successful venture back to the corporate. So they acquire it off us and the founders.
Yeah.
So
that's an interesting point too, to kind of dive into a little bit as well, because I think that's a really good point.
yeah, but so for us, it's like we need to do our due diligence for our IC around what's the likelihood they're going to want to buy this thing back. So that's the strategic element. The second is then really understanding these scale strengths, right? So quite frankly, it's a bunch of expert interviews. It's we're getting better at it because we sort of see these things. So sometimes it's site visits. We physically turn up and look at the depot. It's like, let's have a look at it. So there is a little bit of understanding and putting our own risk assessment on that. But also some of those capabilities, the venture isn't going to necessarily need them in day one. It can take a couple of years as the venture scales to start pulling in on those. So there's some nuance to that. But once we understand those two pillars, the strategic medium to long term like growth areas of interest, the strategic alignment overlapped with their scale strengths of their unique organization and their capabilities, that's where we ideate. So within that Venn diagram is where we will then start ideating for venture ideas. And then the third pillar is very much the VC toolkit, like size of opportunity, timing, market, competition, business model, blah, blah, blah. So the attractiveness of our investments has exactly the same ambition level as traditional venture in the world.
Right. And to kind of double tap on that point around, we want our corporates to, we give them all the ability to buy back, but the kind of ultimate goal is that they'll be interested in buying the venture back from you at year 5. Can you explain a little bit about that and why that makes sense?
Yeah. So, I mean, we've kind of danced around it, but for the avoidance of doubt, when we build, ventures in partnership with large corporations, we do so on a no fees basis, right? So via our fund, we'll invest millions of our own capital alongside the corporate partner from root to fruit. It's only when us and the corporate mutually like an idea that we think is investable, do we, Rainmaking, incorporate the newco in the relevant geography.
And then you invest and they invest
correct.
In the right.
Correct. I can break this down, but essentially we incorporate the newco. We create a venture team of proven founders, so a CEO, CTO pair who've typically raised Series A before. And then ourselves as founders and VCs, ourselves sort of guide that process from incorporation through to acquisition. But what we're really doing is we're trying to ensure that the ventures that we're building are aligned to the corporate partner's strategy from day one. And we're aiming to exit successful ventures back to the corporate, typically in year 5, right? So they fully own the scale business, and then they capture, say, 80% of the lifetime value of the business as you continue to grow from year 5 onwards. And this raises 2 really interesting points. So traditional VCs, investors, would be like, that's crazy. Why would you do that? You're missing the convexity.
Like, because you don't get the unicorn. Like, you'll never get...
Yeah, you're leaving at year 5 and they get to ride it all the way through to like IPO. And it's like, I mean, yes, that is kind of, at first glance, a crazy decision to make from a traditional VC venture capitalist. But bear in mind, the main aspect of our model is about accessing those scale strengths. Because when we do, we get significantly higher strike rates. So compared to a traditional venture of like 1 in 10, 1 in 15, like really wins, we're getting literally 1 in 3, 1 in 2. Like half, or let me be a bit more conservative, 1 of 3 companies we incorporate exits. The strike rate is fundamentally different. But also because we're a studio and the cap table, if the corporate buys it back, the cap table only has 3 stakeholders, us, the founders, and the corporate. And so we're splitting the entire cap table between 3 stakeholders, which means we get a really high equity stake, especially in proportion to the total investment we're making. So when you look at the maths of our model, which is really high ownership stakes, relative to low cost investment to reach scale with a strike rate of like 1 in 3, we do really well in return on investment. But so the model, the mathematics of our investment asset class is different, which is kind of why I allude to the private equity point versus traditional venture capital, which is like you need one venture will return the entire fund plus your IRR. Right. But in order to get access to the scale strengths that make our model and the maths possible, there is this symbiotic partnership with the corporate, which is I want all of these intimate scale strengths. But in order for them to feel comfortable to provide a new co with external talent, like intimate access to their customers, to all of this stuff, the only way we found that effectively ensures good behaviors is to give them the exclusive right to become the acquirer. And knowing that they have the exclusive right to become the acquirer makes them feel comfortable to give us the intimate access and the support which drives us with like the de-risking of the business building process, right, for us. So it's understanding that actually we need to have this relationship. So the give and the take is they give us their scale strengths. In return, we get out at year 5. But that does not mean we make less returns. Actually, I really believe we make way higher returns than traditional venture capital.
Right. I mean, I don't know that any studio can even say that they're exiting 1 in 3, and that's definitely not the case for any venture capital. So the model makes a ton of sense. And I think that, there's so much to be learned from the iteration of kind of your journeys and, how you've built the studio out so far and your plans to expand. I know you guys are kind of moving into the North American market and starting to kind of think through. Have you worked with corporates in the US before?
Yeah, no, we have. So we've done. So for example, our first corporate partner in the US was Morgan Stanley, and we started working. We do work with corporates in the US, and off the back of the sort of, let's call it corporate partner pull, we've now are in the process of setting up a dedicated studio in North America. So we've got a CEO in place, and we're now growing the team and putting boots on the ground to really target the largest market in the world when it comes to this asset class, right? Corporate venture building.
That's so exciting. Are you guys are you kind of raising a fund for the new studio and kind of expanding the team? Are you looking to work with corporates in the near term? Like all of that kind of growth things?
Absolutely, all of those. So we're actually raising we're in the process of raising a new fund at the minute. So we, it's kind of when doing this model, I mean, most studio people will understand, right? Startup studio is an investment as an emerging asset class is way undercapitalized compared to traditional venture capital, right? It's just so few capital has really gone into it for various reasons, which meant that, our fund one, there's an element of like making the fund one size believable, deployable, manageable. Where LPs are still a little bit, there aren't that many LPs that really understand studios and what we do, especially us, which work with large corporates, adds a little bit more complexity. So yeah, we've kind of burned through that capital. We're now in the process of raising a new fund. So yeah, if there are any LPs, absolutely.
Yeah, I was going to say, I mean, there's a lot. It's interesting. It's been an interesting journey to see, the subscribers. I have a newsletter that I put out as well. And so I'm seeing all the subscribers to the newsletter and people very interested to see the number of kind of LPs and people with that kind of a background email address and looking them up on LinkedIn going like, oh, okay, you're interested in the studio model. So I think that there is a lot more interest than there has been in the past, and studios have had a tremendous funding year last year, and I think they're going to do good, really good this year too. So definitely excited. But yeah, for sure, anyone in the audience that I think is listening, if you're a corporate and you're interested in reaching out and working with Rainmaking, definitely reach out. And same thing with LPs. And thank you so much for coming on the podcast. It was absolutely true masterclass in corporate innovation, venture studio building. Learned so much. I appreciate your time. Thanks.
No, pleasure, Diana. Absolute pleasure. Thank you.